Alrighty. So we're gonna first things what how we're gonna approach this as follows, right? So we're just gonna remove what are all the setups which we don't trade, which we don't want to touch, which we don't want to be involved with, right? There's a reason behind it. There's a lot of traders who trade the setups which we deemed unfit to trade. But again, there are a million ways to trade the markets. There are different types of traders out there who has their own system built around these types of setups, like trading a downtrend, trading a reversal from a downtrend. What we categorize ourselves as is trend traders. What does it mean is we buy a stock which is already in an uptrend and then we sell it for even higher prices. So we don't follow the methodology of buy low, sell high. What we follow on our swing trades or buy high, sell higher. So technically, we are buying the strength off of already pre-established uptrend, and then we're selling it when the stock price goes even higher. The pros of doing the same is number one, you're staying in the direction of the big money. By big money, what I mean is the hedge funds, institutions. You got to understand how a trend has been formed first. A trend doesn't form because me and you are buying a stock. A trend is created because millions and millions of shares from millions and millions of dollars from institutions are pouring into a particular stock. That's how an uptrend is formed in the first place, and vice versa for a downtrend, right? Millions and millions of shares are being sold on a daily basis, and that's how a downtrend is being formed. So, you as a retailer, we as a retailer, if we go and buy a downtrend without any indication or without any indication of strength, it's equivalent to you standing in front of a freight train. So it's gonna run you over. So you standing in front of a freight train with a stop sign isn't gonna stop a freight train immediately. So we as trend traders, what we look for is number one, an uptrend, a pre-established uptrend. And again, this can lead to more complications on its own because there is a big difference between buying an uptrend and chasing an uptrend. We'll discuss about more about this down the line. But for now, first we'll start with what are all the setups which we need to avoid. Like, don't want to be involved with it, don't want to chase it. It's not buying low, selling high, or just buying a downtrend. So let's discuss about it, and I'll give you some examples. And if you've been here with me for quite some time, you already know the indicators which we use and what we use to determine the downtrends and uptrends. And if you're new to technical analysis as a whole, let me give you an easy way to do the same. If you have TradingView, open it up, go to indicators, and look for this type along number three, followed by the letter M and A as moving average MA, right? So you'll see the first one from dinar or dinar, however you pronounce it, right? So click on the first one right here. And what you'll see is something like this. Let me show you. Let me go to Nike and you'll see three lines pop up. So what you got to do is go to settings and you'll see the settings input similar to this, right? Length of MA1 is 50 and length of MA2 is 100 and length of MA3 is 200. So change this 100 to 20 and there you have it, the three moving averages which you need. And if you want, you can change the colors. I like my 20-day moving average to be blue. So I'm going to change my 20-day moving average to blue. And there you have it. So you have the three moving averages in place, 50, 20, and 200 of the indicator 3MA. First step, all right? It's an easy way to identify the trend. So when you go to the daily, again, remember, we're only going to use this indicator when we are on a daily time frame. So, and why are we using this is to determine the momentum of a stock, the trend on a shorter time frame basis and on a longer time frame basis. Rule number one on what type of setups you need to avoid as a whole. When you see the daily chart, here the yellow is the 50 SMA, red is the 200 SMA, and blue is the 20. Whenever you see a stock on a daily time frame trading under 50 and 200, number one, and did you see the slope of the 50-day moving average and slope of the 200-day moving average here? By slope, what I mean is you see it's declining and you see the 50 is declining as well. Whenever you see this declining 50 and declining 200, and if a stock price is trading under either of those, time to bail. Put it in the trash can, not interested, leave it alone. Again, the goal is to make money. Goal is not to buy the bottom. You can make money by buying the strength. So whenever you come across these types of setups where like it's under declining 50, stock price is trading under declining 50, or stock price is trading under declining 200, leave it alone. There are a lot of better setups out there which you can trade, which you can make money on by following the trend. This is not one of them. And again, as I said earlier, there are going to be traders who are going to be buying these types of setups. But again, we are trend traders. We're going to focus on stocks which are already in a pre-established uptrend. This is not one of them. So just simple way to determine if it's worth or not. Go to the daily chart to see if the stock price has positively sloping 50 or positively sloping 200. If the stock is looking like this right in front of your screen, where like stock is trading under the 50-day moving average, stock is trading under the 200-day moving average, leave it alone. Not worth it. Too much risk. Let it set up for a while, then we can take it. Let me give you another example on a big no-no type of setup, right? Check out SMCI, another example. Let me remove all these drawings so you can see it clearly. All right, so yellow is the 50-day moving average, red is the 200-day moving average. First question, what's the slope of the 50? Which direction the 50-day moving average is sloping? Right here, to the downside, declining. What's the slope of the 200? You can see it's been flattened out, and now that is declining as well. So 50 is declining, 200 is declining. Doesn't matter, oh, but the news is good. Doesn't really matter. If the news was good and if the stock is looking at the news and think that news is good, we should be in an uptrend. All right, so we are not. The market has been still selling off, and the last 50 days has been absolutely catastrophic for SMCI, and it's continued to do so. And of course, when the stock is in a downtrend, you're going to see some massive rallies like this, as a dead cat bounce, we call it, right? Rally in a downtrend. We don't care about any of these. It doesn't matter. Oh, if I bought it at 17, so I would have made a lot of, again, doesn't really matter. There's a lot of other setups over there which needs our attention compared to this one. There's a lot more time left on the table for us to buy into it, and that time is not there yet. So declining 50, declining 200, stock is trading under it. What do? Put it in the dumpster. Not interested. Leave it alone. So there's another example. Let me pull it up just a minute. All right, so let's take a look at TDW, Tidewater, right? This is a perfect example of a downtrend. So when a beginner trader look at these types of setups, they're going to go to the weekly chart and they're going to draw a bunch of lines and say, oh, this is a support level, the buyers should step in. Well, again, if you trade long enough, you should see support levels act differently when a stock is in a downtrend. Resistance levels acts differently when the stock is in an uptrend. So when you're in a downtrend, pay less attention to all these support or resistance level, pay more attention to the underlying trend of the stock, which is to the downside. Watch the slope of the 50, the yellow line to the downside. What's the slope of 200 to the downside? Again, whenever you see ticker symbols like this, stay away, and immediately goes under failure category. Not interested. I'm not going to buy it. If it goes up, it can go up without you. There's a lot of other stocks which needs your attention. This is not one of them. All right. And this might set up along the way. This will potentially set up along the way. There'll be times where like you will see the stock price consolidate for weeks, and this 50-day moving average will do something like this. When the consolidation happens, it'll flatten out, and the 20 will slowly flatten out and starts crawling back above the 50-day moving average. When that happens, well, we can consider it then. But for now, as I said earlier, the goal is to make money, not to buy the bottom, correct? So wait for the buyers to step in, wait for the institution traders to step in and hold the price level right here. So let them take the risk. Let these traders who buy these reversal trades, let them take the risk. We don't have to be a part of it. We'll wait for the confirmation, which will be the price getting back over the 50-day moving average and consolidate for a while above it, and then we can be involved. These are the type of setups which you have to avoid completely. So now if you have a charts open right in front of you, I want you to check out the ticker symbol TITN, Titan Machinery. So what do you see over there? Is it an uptrend? Do you be involved with this? Or is it a downtrend? This is a different setup compared to that of what we discussed before. Check it out. So you see the price is above the 50-day moving average, or the 50-day moving average is starting to slope to the upside. The price is above the 20 as well. The 20 is starting to slope to the upside as well. But again, we have declining 200-day moving average. What do we do? So it's the previous setups that we saw, the price was under the declining 50, the price was under the declining 200. Well, in this one, it's quite different. For the last 200 days, the price has been in a nasty downtrend, but for the last 50 trading days and the last 20 trading days, the momentum is favoring the buyers. So how do we approach this? The best thing to approach this is, again, same. Either if the price is under declining 200, the price is under declining 50. If either of one of these conditions are satisfied, stay away from it. Not interested. Just stay away from it. Let's give it some time to set up. Why I'm telling you this is because every time you see this declining 200-day moving average, it's just telling you for the last 200 trading days, the stock has been in a bear trend. The stock has been controlled by the sellers. It's been in a downtrend. If it's not in a downtrend, you wouldn't see this declining slope on the 200-day moving average, by the way, because these moving averages are calculated based off of the closing prices of every single candle on a daily basis. So mathematically impossible for a moving average to start sloping down when a stock is in an uptrend. So we are in a downtrend. 200-day moving average is still declining to the downside. The best way to deal with it is wait for a while. Let the price clear the 200-day moving average. And these types of stocks are known to waste our time, by the way. They're not going to offer any big moves. All they're going to do is waste our time by doing absolutely nothing, consolidating until these moving averages correct itself. So if you have a larger time frame on your trades, it's much better to just wait on it, let it sit up, and then take it instead of rushing into it because it's been up like 4% or 5% in a single day. So downtrends can do that. A lot of questions about SMCI a few days back as well. So should I get involved in SMCI? Like, especially after it rallied from $17 to $35, you want to get involved right there. Well, it's already in a downtrend. It always comes under the bracket of guilty until proven innocent. Simple. So these are the type of setups which you absolutely avoid, by the way. Let's take a look at AVGO. This is another example, right? This is a different one. Your stock is under 50-day moving average, declining 20, but it's above the 200-day moving average. What do we do? Again, it's under the declining 50, we stay away. Simple, as simple as it gets. If it's under declining 50, if it's under declining 200, if either one of these conditions is satisfied, stay away from it. It doesn't matter if it has an update for one day or even it might have an update for 1 week. It doesn't really matter. Could you make money from it? Yes, but again, what are the odds of you doing the same thing over and over on a repetitive basis? It's pretty less. So these are the type of setups which you completely avoid. Anything under declining 50, anything under declining 200, throw it in a trash bag. Look for better stocks. Look for better stocks to look out for. Any questions so far? You can unmute yourself and ask right away before we move on to the next step on what type of setups you should actually pay attention to. That's the next one. Now that we took the avoidance part out of the way, this is gonna shorten your watch list by a lot, by the way. You're not gonna waste time into looking at any of these names, drawing support or resistance levels. When you look at the daily and if it has declining 50, 200, why the hell should I waste my time on looking at these setups in the first place? It's a waste of my time. So any questions? We good? All right, so to recap, indicators, 3MA, that's the indicator which we use, which is just a typical moving average. Simple moving average is what we're using. We're not using EMA exponential. We're not using exponential. It's a simple moving average. We don't need exponential because we're swing trading. We're not day trading. We don't need the faster update of data on a daily basis. So SMA will do the work just as good as any other moving averages out there. So simple moving average, 50, 20, 200. If the stock is under the declining 50, if the stock is under the declining 200, stay away from it. Not interested. All right. And then what are the setups we look for? We'll stick to the same daily time frame, by the way. All these are coming only from the daily. We're not even going to look into the shorter time frames for now. All right. So let's talk about the stocks which you're in, by the way. So we'll go to the what are we in? BYD. BYD is a stock which we are in at the moment. So let me remove all these drawings so you can see clearly. All right. So how does BYD look? How does the slope of the 50-day moving average, 20-day moving average, and 200-day moving average look on BYD? 20 is sloping to the upside, check. 50 is sloping to the upside, check. 200 it was flat for a while, and now 200 is also starting to slope to the upside. So this is a stock which is in an uptrend, classic uptrend. Whenever you see setups like this, add it to the watch list. Add it to the watch list. That doesn't mean buy it. Big difference. We don't buy stocks like this. We just add them to the watch list. Watch list worthy. We're gonna watch it to see how it builds. Great. So this is, and we'll look at another example. DLR. This is something which we closed recently. Let me remove the drawings. What's the trend on DLR? 20-day moving average sloping to the upside. Perfect. 50 sloping to the upside. Again, 200 sloping to the upside. So this is a stock which is in an uptrend. And is it worth adding to the watch list? Yeah, absolutely. Add it to the watch list. And again, this is not something which we buy at this moment. I'll go over why it's not a proper risk to reward trade to buy it right here at this moment where the price is trading at right now for a new position. Because if you remember, on Friday is when we closed our entire position at around 197 and change, the one which we entered at around 180s, if I'm not wrong. So for now, this is an uptrend, worth having it on the watch list. Add it to the watch list worthy. Take a look at a firm, AFRM, another name which we traded recently. How does that look? 20-day moving average sloping to the upside, 50 also sloping to the upside, 200 starting to slope to the upside as well. And again, like if you're so into this buy low, sell high, these are the names which made us quite a lot of money last month, by the way. So you don't need to buy the bottom to make money. As I mentioned earlier, these are all stocks which are already in an uptrend, established uptrend. What we're doing is we're just buying the strength from any pullbacks which we get. And once we recover the 5-day moving average, we're going to get involved in it. But this is not about entry and exit. It's about how to rate your setups. So these are the type of setups which you need to have it on the watch list. Need to be about 20, about 50, about 200 at all cost. If that's the case, add it to the watch list. And then the next step will be you going in depth about the analysis, where like you'll be adding support and resistance levels, and you will be looking for any gaps, any AV VAPs, or is there any AV VAPs from year to date or month to date? Well, that's after that is when you're going to go into all these intricate details of the analysis part. But for that to happen, the first condition need to satisfy, which is the stock needs to be in an uptrend. And let me give you another example. And what else we got? What else did we trade? SCHW. Let's take a look at it. SCHW. What's the slope of the 20? Sloping up. Slope of the 50. Sloping up. Slope of the 200. Also sloping up. What does it mean? Stock is in an uptrend. Simple as that. So is it worth adding to the watch list? Absolutely. So hope this makes sense. Simple. As simple as it gets. No complications whatsoever. Simple doesn't mean ineffective because you saw the performance on the small accounts. You saw the drawdowns on the small accounts. Keeping it simple sometimes is the best way to go about it. So this is how simple as it gets to look at the chart, just 3 moving averages, and see what's the trend is from a daily time frame alone. We don't use these moving averages when you look at 15 minutes or 30 minutes. Doesn't matter to us. It's more noises. We don't want to clutter our charts with a bunch of colored lines flowing around here and there. When you go to the smaller time frames, we already discussed what to do over there. The 15 minutes, like 5-day moving average and ATR. We discussed this in the last session. If you haven't checked that out already, I posted the video for the recording for the last session in the Patreon's Only Learning and also in the beginner's guide. Go ahead and check that out as well. That goes over the entry strategies on how to enter a stock and all this other stuff. But for now, hope what type of setups are good to add to the watch list or clear. Positive 20, positive 50, positive 200. Great. Add it to the watch list. And now, any questions so far? We went over what stocks to avoid completely. And we also went over the stocks which are worth adding to the watch list. If you want more examples, you can just go into the small accounts. Every single ticker symbol which is mentioned over there are charts in an uptrend, by the way. So right here, if you look at AS, which is something we traded a while back, uptrend, positive 20, positive 50, positive 200. So we are good with an uptrend. And if you want more examples of an uptrend, again, as I said earlier, go to the small accounts tab and check out all the ticker symbols which have been given over there. Every single stock, I can bet you right now, none of the stock over there, it's going to be in a downtrend. By the way, UPST, right here, positive 20, positive 50, positive 200, stock is in an uptrend. Well, there you go. As simple as it gets. We only trade these types of setups. Now we're going to go in depth on what's the difference between buying an uptrend and chasing an uptrend. If we notice something when we were discussing about the DLR, I said this is not the place where I will be buying it. And there's a reason behind it. And we also mentioned about there's a difference between buying an uptrend and chasing an uptrend. What's the difference between, what do you guys call chasing, by the way? So what is chasing according to you? So for example, I had a question about SMCI in the chat from someone who just joined the server. And they were asking about, should I buy a long call option on SMCI right here, if I'm not wrong? This area. This happened on last Monday, right? So pretty simple case. Look at the daily chart. Always ask yourself, where did the stock price come from? Simple question. When you're looking to buy anything, just ask yourself, where did it come from? In case of SMCI, let me give you an example. The price sold off all the way to $17.20. All right. Sold off to $17.20 and rallied right here all the way from $17.20 to $38, which is almost 130% rally in 1, 2, 3, 4, 5, 6, in 7 trading days in a week. 130% rally in a week. So now, whenever you look at the chart and ask yourself, okay, should I buy it right here? First question to ask yourself, where am I going to set my stop losses? Stock just rallied 130% in a single week. What are the odds? And rallied right into the declining 50-day moving average, number 2. Number 3, there is no place for me to set the stop losses on for a long option. Number 3. So is there any point in buying it right there? What is the risk to reward of you making any money? And what is the risk of you losing? It's already in a downtrend. It just rallied 130%. And now you want to buy something new? Doesn't make sense now, does it? So this is what we call as chasing. This is what we call as FOMO. So how the typical psychological aspect works here is traders who saw this used to be a darling name of semiconductor space, if you remember. And I'm pretty sure you guys have been trading in SMCI. Used to be a big shot when it comes to the semi space. And until most recently, where like they got hit with back-to-back news about some fraudulent activities, but that doesn't really matter. But for now, it used to be one of the darling retail names, and then they just fell from after the split. They just got absolutely obliterated. And now people look at this and go, oh, okay, this sold off pretty much. I'm going to buy this right here because if the news is bad, if the news turns out to be just another hoax, the stock is going to go higher. Some traders would have bought it right here, like 21. Some traders would have bought it at 17. Some traders would have bought it at 20. Put yourself in their shoes. Let's say you bought it at 20. Let's say you bought it at $17. And the price just went up all the way to $38 to $39. What will you do? It's almost like almost 80 to 90% from your entry price. What will you do? If you are in that shoes, if you buying at 18 or 17 or 19, what will you do at 38 or 39? And the price is sitting right at that important area of declining 50. You're going to look at the charts. Any smart person is going to look at the chart and go, I made 90% in this name, so I'm going to take some profits off the table, right? So now they're going to take profits off the table. And this is where you're going to look at the chart and go, the new retail traders are going to look at these charts and go, okay, I missed this entire rally. So what I'm going to do is I'm going to buy it right here so that like if it goes up even further, and there's a gap right here which needed to be filled, so until $49. So I'm going to buy it right here, and then I'm going to ride it all the way to $49. Well, if you've done that, let's say you bought it right here at $38. Well, you just lost 18% of your positions, 18% of your initial investment. 18% of your initial investment gone, just like that. Not something good. Even if it goes higher from here on, doesn't really matter. Losing 20% of your initial investment after your entry, especially on a swing trading position, is not good. Not something which you need to look forward to. And especially if you're taking this with options, And let's say you bought some bunch of 40 or $50 calls expiring next year. Well, that options are absolutely cooked right now at this moment. There's always a better entry. But again, it's all entries are always in the hindsight, right? You don't know if you got a better entry or not until after the fact. But anytime you see a stock price rally like 130% or 140%, well, leave it alone. So this is something which is in a downtrend, but let's talk about stocks which are actually in an uptrend. DLR, for instance, right? DLR is something which we got involved in right here, if I'm not wrong. When did we get involved in? 1st of November, right? So around 180s, and during November 5th or November 6th is when we get involved. Let me anchor the VWAP to the gap up candle. Yeah, around here, right? So around November 8th is when we got involved in this name, and with stop losses at 175s and change. So we got involved at 170, 180s, and again, this thing pulled back a little, consolidated for a while, and then ripped all the way towards 197s. So a lot of new trade, let's say a lot of new members just joined, and they look at the names when we discuss about trimming our positions on DLR, closing our positions on DLR. Again, the first question, what do we ask ourselves? Where did the stock price come from? Where did the rally is coming from? This thing just rallied from $177 to $197 in how many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 trading days. That's almost a 12% move. 12% move. So the ATR on this name is $3.78, and the stock just rallied almost like $20, which is how many ATR? Let's call it 4. It's almost like 5 ATR moved to the upside in 10 trading days back to back. Are you going to buy it right here at this moment at 195? Absolutely not, because the price just rallied 5 ATRs back to back. And what do we do right here? We add it to the watch list and we wait for the price to retrace. Retrace to where? Retrace towards maybe towards a 50-day moving, retrace towards a 20-day moving average perhaps, or retrace towards this AVWAP from this gap up candle. Who knows, right? Let them retrace and let them log something called as a higher low. Because right here, you can see there is a low. Oh, sorry, this is an AVWAP. Let's remove this. Yep, this is a low right here, correct? And there is another low right here, which is a higher low. This low is higher than this low which they created previously. A low, higher low. So what we expect here is let them pull back a little bit and then log another higher low here and then recapture the 5-day moving average. And that is where we're going to enter. Not here, not here, not here. So you wait for the higher low to log and then buy the strength off of that higher low if you want to get involved. All right. So our first question to ask yourself is what? Where is it coming from? Where is the pullback started? Where did the stock price rally from? So that's going to differentiate buying an uptrend and chasing an uptrend. Let's talk about Affirm a little bit. Will Affirm be, if let's say you're going to buy Affirm on Monday, is it going to be buying it or is it going to be chasing it? Go ahead. Let me know what your thought process is. First question, where is the stock price coming from, right? So right here, from $42 to $70. This thing just rallied 40, it's almost like 70% rally in literally 2 trading weeks. Well, what is it gonna determine? It's chasing, exactly. This will be chasing an uptrend. I'll tell you why. The stock just rallied from $43 from bounce down, found buyers at the 50-day moving average, ripped all the way to the upside, and ripped almost 70% to the upside. And let's say you didn't get involved here. Let's say you didn't get involved here. You didn't get involved here, 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 or here. And you look at this chart and you're going to look at this at $70 and go, oh shit, this thing just rallied quite a lot. And people in the Discord are saying it can go even further, or people in the news channel are saying, or the so-called analysts are saying, oh, the price target on Affirm is at 100, so let me just buy it right here. That is how they get you. It's FOMO is fine, but you convincing yourself that it's not a FOMO, that is a bad thing. Let's call a pig a pig. So this is FOMO, this is chasing, because there is no area for you to put a stop loss on. This will technically be chasing, but stock is in an uptrend. Absolutely. You have a 20-day, you have a 50-day, you have a 200-day moving average. All satisfies our conditions, right? 20 is positively sloping. 50 is positively sloping, 200 is positively sloping, but we still won't buy this because the stock has already rallied, the stock has already left the train. But now this is where the psychological aspect comes in, right? If a new trader look at this name and they're going to go, if I got this at $44, and if I held it all the way towards $70, I would have made a lot of money. Well, if my grandmother had wheels, she would have been a bike, correct? So it doesn't really matter. Don't worry about things which you missed out on because there's a lot of other names which we can get involved in, perhaps make the same amount of money down the line. So don't worry much about the stocks which you missed out on. Doesn't really matter. If you missed out, well, fine. There's millions of ticker symbols out there which you miss out on a daily basis. You're not involved in all of them. There are some penny stocks which goes up 10,000% in a day. Were you involved in this? No, you're not going to feel bad about it because you're never aware of it in the first place. So similar to that, doesn't really matter. If it's an uptrend, if it's gone, it's gone. Put it in the watch list, wait for it to log a higher low, let them pull back down towards the 20-day moving average, and go to the weekly time frame to see if you can see any areas of interest down the line. What is the area of interest down the line? You got $54 right here on the weekly charts. Mark the $54, and the $54 zone also coincides with this previous highs right here on December of 2023, the $54 to $50 zones. Go to the daily chart, and if they consolidate for a while, this 50-day moving average is going to start sloping up towards this $53 zone. Let them pull back towards this area. Let them pull back towards this $654 to $50 zones to the downside. Then we can consider, once they recover the 5-day moving average from there, that's when we're going to look for entry price to take it all the way up again. So we're going to wait for it, and then we're going to take it. That might happen in next week. That might happen 2 weeks from now, 2 months from now, or 3 months from now. Doesn't really matter. Doesn't really matter how long it takes. And I'm pretty sure people who've been with us for quite some time already know this story. I've said this multiple times. And the ticker symbol Monster, MNST, right? And during December of 2022, if I'm not wrong, 2022 to March of 2023, this is something which we had on our watch list for quite some time. You can see it right here. From November to December of 2022, all the way to March of 2023, this stock has done absolutely nothing. If you go to the daily chart and go to this time frame which I spoke about, November of 2022 to March of 2023, you can notice this. Absolutely nothing. Flat consolidation. This is the only stock which we had on the watch list for almost like November, December, March, November, December, January, February, almost 5 months. Almost 5 months just sitting on our watch list doing absolutely nothing. But again, we waited. There is no reason for us to get involved. So what we're waiting for is we're waiting for the stock price to get over that price point. The breakout and retest strategy is what we call it, right? So check out what happened. Mark the highs and mark the lows. Every time the consolidation lows is not breached, they broke above it. And we still didn't get involved right here, by the way. We didn't get involved right here. What we did was we waited for the stock price to pull back, and how many days they consolidated above this breakout area? 1, 2, 3, 4, 5, 6, 7, 8, 9. After 10 trading days of just pure consolidation and doing nothing, you got that actual move from $52 all the way to $60 to the upside. On a percentage basis, we're talking about almost a 15% move to the upside, by the way. So the point is, adding it to the watch list, it can take a lot of time to set up, to check all our boxes, by the way. If you missed out, you missed out. Don't worry about it. There'll always be another opportunity to take the same and ride it all the way back up again. Or if you're someone who likes to short the markets, unlike me, so you can go ahead and do so. But that should be happening only in the trend. So whatever we are talking about right now, just reverse it. If you like to short the markets, it's completely reverse. Don't short up trends, only short the stocks which are under declining 50 or declining 200. And again, same questions shows up, like where did the stock price come from? Don't short a stock which has already dropped like 40, 50% from the recent highs. Wait for the stock to rally back up to form something called as a lower high. So completely opposite of whatever we discussed about when we are longing the name, and shorting the same goes opposite. So just complete opposite of whatever we discussed. If you like to short the markets, declining 50 is what you should be looking for. Declining 200 is what you should be looking for. Don't short uptrends. Just like how we don't buy downtrends, we don't short uptrends, by the way. For someone who are new to the markets, shorting refers to you making money when the stock price goes lower. Long refers to you'll be making money when the stock price are going higher. So bullish means long, bearish means short. So technically, more or less. All right. So hope the difference makes sense, by the way. I'll go over one more example for you about buying and chasing an uptrend. Let's take a look. UPST. UPST, we're already in this position, so let's not discuss this. It's going to be easy. So let's talk about TRV. Not a good example either. Okay, Goldman Sachs is a good example. We were actually in this trade and we actually got stopped out on this one, by the way. So Goldman Sachs, take a look at it. Let me know, will you be buying here? If you want to buy something right here at this level, will it be chasing, or will it be you buying an uptrend or chasing an uptrend? And you can unmute yourself and give me a reasoning on why. Feel free to do so, because there's no wrong answers. I would love to hear what you guys think about the same setups, because not everyone views the same chart the same way. Go ahead. Let me know, will it be buying or will it be chasing Goldman Sachs? The daily is in an uptrend. So if you go to the daily chart, you can clearly see the 20 is sloping upside, 50 is sloping upside, 200 is sloping upside. Everything which we're discussing right now, or the stocks which are already in an uptrend and are watch list worthy. Chasing is still up, wait for a retracement. Perfect. And can you tell me why? Why is it considered to be chasing at this level, and why not buying? And when will be a perfect chance to buy? At a resistance, wait till the VWAP tap. VWAP from where? VWAP is an intraday indicator though. So if it's a normal VWAP, it's just on an intraday basis. From the gap of VWAP, all right. Look where it came from, exactly. So this rally started from right here, 575, all the way towards $615. So they rallied almost 40 points to the upside from where they were at. So gap up AVWAP, beautiful. So what do we do here? We need to make a higher low, Greg, not lower high. We need to make something called as higher low. So we have a low right here. I wouldn't call it low, but for now, low. There is a higher low, gapped up, but try to close the gap, but found support. Now we are trading higher. J, this is something about the gaps. These types of gaps are what we call breakaway or runaway gaps, by the way. They take a long time to get filled. Most of the time, they don't get filled for months. So it's pretty common these are the type of setups which we typically trade. So these are the type of gaps which don't get filled quite a lot. It's very rare for the stock to completely give everything up, to go down to fill that gap. Very rare thing to happen. So whenever there's a breakaway gap, something to keep in mind. I believe this is the election date, right? Election gap up happened. So we'll see. For now, this will still be considered chasing an uptrend because, well, they were already been rallying for quite some time before we got there to this level. So now that gap up, well, kept pushing it higher and higher and higher. We're trading at new all-time highs. There is no way of telling. I'm pretty sure they're above the 5-day moving average as well. Yep, they're above the 5-day moving average. They're above the 20, 50, and 200, still in an uptrend. But again, not a good place to buy a new position. The best thing to do is wait for them to retrace back towards this 593s to see how the price is reacting. But again, will you be buying this at 593s? Will it be a good place for you to buy it right there, or are you going to wait for a while? Then that's another question. This is where the probability step in, correct? Markets are trading at all-time highs. Goldman Sachs is a major part of XLF. If markets enter the corrective phase, what's going to happen to the major component of XLF, which is the second most leading sector on all of S&P 500? What's going to happen to Goldman Sachs? It is going to pull back alongside with it. If the S&P 500 corrects 10%, which is very common in a bull market, by the way, very common to see 10% corrections in a bull market. If that happens by December, Goldman Sachs, which is a major component of XLF alongside with JP Morgan, what's going to happen to that? It's going to retrace back. But again, if it retraces back, it's going to give us a better opportunity to enter, maybe towards at the 20-day moving average. If they pull back towards the 20-day moving average, or maybe towards the 50-day moving average, which will be at around 538s or 540s. We'll take it from there. But for now, leaving it alone. Add it to the watch list. It's not all-time highs. Like nothing wrong with the chart. Everything is looking absolutely beautiful with this one. Don't short an uptrend. Again, this is not something where you go on, oh, they rallied a lot, I'm going to buy a bunch of puts. Well, you never know how high a rally can go when a stock is trading in an uptrend, by the way. Ticker symbol AM, great example for this one. Let me remove all these drawings so you can see it clearly in all these indicators. There we go. Right, so right here, if you notice, this stock has been just consolidating for quite some time. And in a you can draw a channel right here. You can draw a channel right here, and the stock has been just doing absolutely nothing, right? Once they broke out of the channel, they rally, and let's say you draw a resistance level right here, and let's say you go, oh, okay, this thing rallied quite some time, so I'm going to short this. This is a resistance. The stock just rallied from 141 all the way to 158, and they're heading into a resistance area. I'm going to buy a bunch of puts right here. What happened? They just broke through and continued even further all the way towards 180s. So again, wait for the confirmation and do not short an uptrend. It's one of the examples of why doing so it's going to be painful, not just to the portfolio, but also to your mental health. Not worth it. So stop shorting uptrends. A bunch of stocks which you can actually short and make money off of. This is not one of them. All right. So now, hope the difference is clear, by the way. So what you can do right now is go over different ticker symbols, different charts to see if you can identify the difference, or where is it coming from, or am I buying it or am I chasing it? So the big difference will be seen right there. Check out the ticker. Let's do a small exercise, right? Check out the ticker symbol AON. This is something which we have on our watch list. I'm not sure if you open the positions on this or not. I doubt it, but we do have the stock on the watch list. Look at this chart and tell me if you want to buy this one right here. This is in an uptrend, by the way. So just to clear things up, everything is in an uptrend. 20, 50, 200, all are positively sloping. Great looking chart. Great breakout on the weekly time frame or on the daily time frame. If you go to the weekly, you can see it clearly. Well, broke out of this range right there, which they've been having since April of 2022, consolidated about that range for a while, and then broke through. So now go to the daily, look at the charts, and tell me, if you want to buy this right here, will you be buying or will you be chasing? Go ahead. What's the first question? Chasing. Why? What's the first question we ask? Where is it coming from? So even if your trading time frame is a bit short, the stock still rallied from the AVWAP, from the gap up candle, from the earnings, right? From the gap up candle on the earnings, $375 all the way towards $391. They just rallied $20 to $25 to the upside. Not a perfect place to buy at the moment. This will be considered as chasing. And from the breakout zone of 344, this thing just rallied like $50 to the upside, which with an ATR of something of 7 points, we're talking about almost 7 ATR rally from the breakout zone, by the way. 7 ATR rally. The volatility contracted right here. As you can see, the price has just been consolidating above the breakout zone, ripped all the way through, earnings costed to gap up even further, and now we are pushing through. It's almost a 7 ATR rally to the upside. At this point, this will be considered chasing. All right, so now we discussed about chasing and what not to do, and when will you actually buy these things, right? So it seems like every setup I show you guys, it always seems like, oh, don't do this, don't do that. What should we actually do? That's the important question which we need to answer at this moment, because that's what's going to make us money, right? So it's in an uptrend. Well, great, but it's an uptrend, but you're chasing. Oh, but what about this stock? Oh no, it's in a downtrend. Don't do this, don't do that. But what to do? Let me give you an idea. This is where trading one type of setup comes in handy, correct? If you go to the small accounts tab, check out every single ticker symbol which has been shared. You'll see one thing in common, or anything which you see in the watch list page, current watch list page either. So current watch list page as well. So one thing in common, which is every stock, you'll see a gap. You'll see a gap on all of these names. AON, for instance, this is something which we had on our watch list, correct? So what do you see? Gap right here. Take DLR, for instance, which we traded before. Gap right here. And Affirm, did we have a gap? Should be having a gap. Yep, right here. Affirm, there is a gap right here. From April of 2024. And there's a gap right there, and there's a gap right here from the earnings. And we didn't trade this gap, but we did trade this gap right here. So there is a gap. And what are the stock? Upstart, UPST. Well, there is a gap right here from the earnings. November of 2024, November 8th, 2024, there is a gap. And BYD, which we are at this moment, currently trading at this moment, there is a gap right here from October 25th to October 26th of 2024, gap. One thing which is common on all of these names is the gap ups on an uptrend after earnings. So you will see a template there. What's the purpose of this? What we typically do is wait for the stock, wait for the earnings, or wait for any of these news events and look for these gap ups in an uptrend. These types of gaps are typically either a breakaway gap or runaway gaps. There are four different types of gaps when it comes to the markets, by the way. Number one is common gaps. Number two is breakaway gaps. Number three is runaway gaps. And number four is exhaustion gaps. All right. Common gaps are the gaps that you see in, for example, the SPY or QQQ on a daily basis. If you remember, like the SPY gaps up like $2 and comes all the way back down to fill the gap on the same day and then recovers to the upside. Those types of gaps are what we call as common gaps, by the way. Common gaps are the gaps which gets filled on the same exact day. The gap will be open at the market open, and then you'll see them completely pushing down, filling the gap, and then continuing on with the current direction of the trend. And you'll see that in QQQ as well. If you trade QQQ or NQ, if you see a gap on the QQQ at the open, when the NQ rallies all the way to the overnight without any pullback, as soon as the market open, you'll see the back-to-back red candles until they fill that gap and then continue in the direction of the trend on whichever side they go. These are the type of gaps which we call as common gaps, by the way. And then there is something called as breakaway or runaway gaps. Let's talk about QQQ when they're in the topic of the same. So if you, oh my God, this charts, man. Let me hide all these drawings. All right. So when you look at the QQQ chart right here, you'll see a gap on election day. There is a huge gap right here from 492 to 500. There is a gap right there which still is not filled. So this type of gaps is what we call as breakaway gap. Or this is technically a runaway gap because we were already in an uptrend, but for now, just an example, this gap still didn't get filled. Let me give you another example. If I'm not sure if you're familiar with the Duolingo stock, DUOL. This is Duolingo. And if you go all the way towards, is it March of 2023? Not wrong? Yep. All the way towards the February of 2023 on a daily time frame, you'll see a gap right there. After earnings. This happened after earnings as well. There's a gap right there. That gap still did not get filled. And this happened in 2023 and we're almost in 2025. This is an example of a breakaway gap. If a breakaway gap is something where, like, let's say a stock isn't trading in a downtrend, all right? Stock has been in a downtrend. You see a massive gap up, which changes the direction of the trend because of the gap. Those types of gaps are what we call as breakaway gap because they broke away from the direction of the trend to form a new trend to the upside or to the downside. Breakaway gaps can happen to the downside as well. So if a stock has been trading in a downtrend for quite some time and some news event happened which gaps the stock higher, breaking the previously ongoing trend, that's what we call as breakaway gaps. Runaway gaps are something different. The Goldman Sachs is an example for that. GS, what is this? If you go to the Goldman Sachs charts, Goldman Sachs was already in an uptrend. And then the election happened. The stock gapped up, continuing in the direction of the previously existing trend. You can see before that gap happened, the stock was already above the positive 50, positive 200, and positive 20-day moving average. The gap up happened in the direction of the pre-existing trend. So they're running away even further from an already existing trend. So it's what we call as runaway gaps. So something to note here from both of these breakaways and runaway gaps takes a long time to get filled. It's not something which happens on a daily basis. So when you look at these types of gaps, which you see on earnings, don't immediately look at the charts and go, oh, there's a big gap which left to be filled to the downside, so I'm going to short this. Please don't do that, because that is gonna hurt if you're wrong, and which you will be most of the time. Take LLY for instance, right? So there's a lot of gaps in LLY, and every time LLY gaps up in the earnings, you'll see one thing: oh, there's a huge gap which left to be filled to the downside. Well, let's take a look at it. From August of 2023, go to the daily chart, look at the gap right there from August 7, 2023 to August 8th of 2023. There's a huge gap up from $453 all the way to like $504, right? What happened after? Let's say you look at this chart and go, I'm going to short this because there's a huge gap needed to be filled to the downside. Well, this thing rallied from $504 all the way to like $630. And the next earnings happened. Well, they continued going. They continued going all the way towards $980 before having any corrective behaviors. Are you sure these are the type of setups that you want to go short on just because there's a gap downside which needs some stuffing? Don't short the gaps because they might potentially fill it down the line. And the worst part is most of you do it with options as well. So you can at least get the probability of the prices from the charts, but you can never get the probability of by what time that will happen. So difficult to do. Just be cautious on shorting these types of names, and something to pay attention to. So yeah, that being said, the first thing to focus on, look for the gaps. All right. There is, if you're asking for some scanners which will do the same, I have a video on how to use the scanners, which is from Stocks Charts, and I will share it in the Zoom link right now, so you can go ahead and take a look at it as well. This is how I find my setups, by the way. Same process. You don't need to be a rocket scientist to do the same. You can do it on your own as well. So I just shared the link. So that's the scanner which I use. You don't have to pay someone like $100 or $150 to buy the same shit which you can do on your own. So learn how to use this one and run the scanner, especially during the earnings season. And if you're not sure which company is reporting earnings or which company is like gapping up or whatever it is, use this scanner. And this, what it's going to do is it's going to run through every single ticker symbol which is an S&P 500, every single ticker symbol which is an S&P 400, and every single ticker symbol which is an S&P 600. So mid caps, small caps, large caps. It's going to run through every single ticker symbol and look for these breakaway gap or runaway gap. Is there any breakaway gaps on S&P 500 stocks? If there is none, it's going to tell you none. Is there anything on the mid-cap space? If there is none, it's going to tell you none. If there is something, it's going to pull up for you. So now take the stocks, whatever it pulled up for you, add it to the watch list. To see, first question, what do we ask ourselves? If I buy this right here, am I buying it or am I chasing it? So now, when to buy it? We'll talk about it. So every time you see these types of gap ups, what you typically do is you're going to anchor the VWAP coming from that gap up candle, the TRV. Let's talk about it. TRV is an example for the same. So you do see a big gap up. I don't know what it is. I think we just drew it. Let's remove all these lines. And I'll teach you how to anchor the VWAP as well. And I can see most of you guys are going to indicators and looking for AVWAPs. You don't need to do any of that. It's very simple. On your left-hand side corner of your screen, do you see a bunch of menu options? Well, like 1, 2, 3, 4, 5. Click on the fifth option where it says forecasting and measurement tools. Click on that small arrow right there. If you go down, you'll see something called as anchored VWAP right there. Click on this tiny star and it'll be displayed right on your screen up top. And all you need to do is click on this anchored VWAP and select the candle which you want the VWAP to be anchored to, and done. As simple as it gets, by the way. You don't need to go to indicators and look for anchored VWAP and do any of those nonsense. TradingView, it's inbuilt. You don't even have to use any indicators to do the same, by the way. You can do it for free. But sometimes if it's the first time you're doing the same, you're going to get 3 lines. In order to remove that, go double click on that anchored VWAP, go to style and remove all these bands, but the price label. Just leave the price label on, remove all of these bands, because when you first do it, it's going to be looking something like this. It's going to be looking something like this, and we don't want that. So we don't want our charts to get ugly, like don't want the charts to look like a pride flag. So just remove all of this and just one line, that's it. So one line and anchor the VWAP, which is coming from the gap up candle. There's it gapped up, anchoring. Hi Mario, and yeah, before we move on, hi Mario. I hardly ever hear you mention do not take into account. Oh, we do take into the account. We'll discuss about that down the line. We do take volume into the account as well. So the breakaway, when we discussed about the breakaway gaps or runaway gaps, so if you notice something on the same chart, we do have volume right under, by the way, and there's a small line floating above that volume chart, which is the 20-day moving average on the volume. So what we look for during this gap, do you see a spike in volume? Well, the rest of the day, the volume was been like around 951K. And after this earnings gap up, the volume was 2.81 million, 2.85 million. So which is almost like 2 times the average volume, which the average volume is 1.14 million for the last 20 trading days. Well, 2 times the average volume, which is not a lot, but something to pay attention to. And we anchor that gap of candle. So only thing which I look for in these volume is sometimes they're going to come across these types of ticker symbols, which will be looking absolutely great. Checks all our boxes and checks all our rules. Everything will be great. But when you look at the volume will be like 250,000 shares per day. 250,000 shares. That's the volume. And if you wanna know how to find it, go to indicators and just type volume, and you'll see something like this down under. Put your cursor on top of where you want to see the volume for the candle for, and on top right here near the indicators, you'll see 2 numbers pop up. The first number is the volume that's been traded for the day. For example, on October 17th for TRV, the volume was 2.85 million shares traded. And for October 18th, the volume was 1.58 million shares, which was traded. On 21st of October, it's 1.31. So this is how you find the amount of volume which has been traded for the particular day, by the way. Just make it as a rule that do not touch any stocks which has an average trading volume under 500,000. If that number is 100, 500,000, regardless of how good a particular setup looks, stay away from it. I'll tell you why. Because if a stock has an average volume of 250,000 every single day, technical analysis, the price is going to be a bit more volatile, a bit more shaky. It's not going to follow our typical norms. A small amount of selling is going to cause a huge downflex in the price action. A small amount of buying is going to push the price all the way back up again. It's going to be nasty. We don't want to be involved in nasty. Simple. If you see the volume less than 250,000, average volume less than 250,000, stay away from it. Not interested, don't buy it. This goes for penny stocks as well. Some penny stocks have a volume of 5,000 shares, 6,000 shares a day. And you'll see these people pushing these penny stocks with 5,000, 6,000, because those 5,000 shares comes from these people. They'll be buying all the way across, and then they'll share it. And all of these new retail traders buy into that 5,000 average volume stock. And all of a sudden, the average volume spikes up. The volume for the particular day spikes up to 3 million, creating an artificial demand. And you are the liquidity for them to dump their shares. This is what we call as pump and dumps, by the way. So it's not possible for these types of things to happen with a 250,000 volume stock with a higher valuation on a bigger companies. But you'll see this commonly happening in these penny stocks, and you see how it typically goes when they actually rally towards like 300, 400% to the upside. But if you see a volume less than 250,000 or less than 500,000 on a stock, avoid it all at once. Not worth it. Not something which you need to be paying attention to or getting yourself involved in. You won't have enough liquidity to sell them in time, even for shares, by the way. And you're going to have to do the limit price, limit buy, limit sell. So it's a pain in the ass. Why do you have to put yourself through it? There's a lot of better setups with decent volume. So stick to them. Much better, much safer, better liquidity as well. And especially if you trade options on the same, well, it's going to help you over there as well. So if you're going to trade options, avoid anything which with an average volume less than 750,000. It's going to help you with getting a better spreads, by the way. If you notice something, if you traded stocks like AMD or SPY, the bid to ask will be so tight. It will be like 1 cent or maximum 5 cent difference. That's all you're going to see. But if you look at the stocks like TRV and look at the options on TRV, you're going to see the bid to ask 15, 20, 30 cents wide, which is not something which you want to see if you're trading options. It's going to become a terrible thing to sell, and you can't sell it on time because the bid to ask will keep fluctuating. And if you want to sell it, you need to resort to shaving off some of your profits just to get your order filled. Not worth it. So keep that in mind. If you see a stock with an average volume less than 250,000, sorry, 500,000 for shares, just avoid it. If you're trading with options less than 750,000, avoid it all at once. Not worth it. All right. So now, whenever you see these types of gap ups, anchor the VWAP to that gap up candle. So what do we do here is we're going to wait for a while for the price to get back over this anchored VWAP. I'll show you something on stocks which it actually worked out, and then I'll show you something on the stocks which didn't work out. And what did work out is AFRN. AFRN or Upstart? Did Upstart work out for UPST? All right. So UPST, what we did here was, when did we get involved in UPST? Do you guys remember? Around $70 and change, if I'm not wrong. Let's go to the 15-minute time frame so you can see it clearly. Yep, we got involved in UPST around right here, around $70 and changes when we got involved in the UPST, 70 to 71.50. Because once the 5-day moving average started sloping to the upside is when we got involved. And then once they cleared this AVWAP coming from the earnings, what it's telling you is the average buyers who purchased this gap up candle right here. This AVWAP is going to tell you, are these average buyers making or losing money? That's all it's telling you. If the stock price is trading above this AVWAP, all it's telling you is the average buyers who bought this candle, bought this gap up, are making money, which puts more pressure on the sellers because the buyers are still in control of the trend. And as it continues to keep pushing higher and higher and higher, the sellers are going to get stuffed, and the odds for a short squeeze rally to the upside, pushing the price even further up, is higher. So vice versa. If the price is trading under that AVWAP, well, the average buyers who bought this candle are losing money. The chances for the sellers to stuff these buyers, and if it continues to keep going down, you're going to see some short squeeze to the downside, which is going to push the price back down even further. So the AVWAP is pretty simple, telling you whether the average buyers or average sellers, who are they making money or are they losing money from that particular point of your anchor. Right? So we only anchor these gap up candles because these gap up candles are typically combined with a huge volume. Go to the daily chart to check out this volume on UPST's candle, by the way. The average volume is 8.6 million on this stock. The volume for this particular day on a gap up is 40 million, which is 5 times average volume. Anytime you see a 5 times average volume or 6 times the average volume on a particular trading day, it's just telling you there is a little bit of an institution involvement in there. So when we anchor the VWAP to this candle, all we're looking for is whether if the institutions who bought the gap up candle, are they making money or are they losing money? If they continue to lose money over and over and over again, you're going to notice it from the trend overall, but you see what happened. They rallied all the way up. It was a beautiful day. Mark the highs of this candle and mark the lows of this candle. So when they did pull back, if we go to the shorter time frames, when they did pull back, all they did was came back to run a test towards this lows, found buyers, and ripped all the way back up. And we got involved once the price got back over the 5-day moving average, which we went over on the entry basis. At this time, it's a better entry to get because, well, you have a proper area to set your stop losses on because price told you this area is important because they tested it multiple times. They didn't break under it, and then they completely rallied up to make new highs. Well, these areas becomes important. So now when you enter it right here at around the 69 or $70 zones, you can clearly say, okay, if the price got under the $64, I will be wrong. So I'm just going to cut it for a small loss and move on with my life and look for better stocks to trade in. That's exactly what we did. Our entry was somewhere around $70 and change, and our stop losses were somewhere around the $64 for our initial position. And when we averaged up above the $73, we moved our stop losses up towards this lows at $67 or towards this lows at $69. So you need to have a stop loss area to set from the recent lows and the 5-day moving average. When the price got back over the 5-day moving average, if the stop loss is within the 1 ATR vicinity, you can take the risk right there. If whatever I'm saying doesn't make sense for now, go back and check out the ATR and 5-day moving average video. We have covered exactly when we enter particular trades. It goes over in depth. It's a 1 hour video, so go over and it goes over in depth on how to use this 5-day moving average and how to use this ATR to set your stop losses as well. Right? So go ahead and check that video out. It might help you out when it comes to the entry price. But for now, if you're looking for stocks to add to the watch list, positive 20, positive 50, positive 200. Great. But again, the way we trade is we look for the gap ups, runaway or breakaway gap ups on top of positive 20, 50, and 200. That's the added conditions which we look for. And that's the only setup which we trade right here. We need the stock to gap up, number one. And that gap up should happen in already pre-existing uptrend, or that gap up should create a new uptrend by breaking the previous downtrends. Breakaway gap or runaway gap. Either of those conditions should be satisfied. So if you want to identify, again, there's a lot of stocks out there which satisfies this condition, by the way. That's why I always say don't trade one stock over and over, trade one setup over and over. And if you look at the small accounts, these are the same setups which we trade over and over and over and over again, by the way. And hey, it's for swing trading and it's been giving beautiful results. And as you can see in the P&L tab, right? So drawdowns will be minimal because we always set our stop losses to 1 ATR. And if you're wrong, we'll lose 0.4% of our entire account and no more than that. And sometimes we average up and then we get stopped out. At that time, we'll lose like 0.6 to 0.7% of our entire account, by the way, no more than that. And by trading this way, even if we get stopped out like 5 to 6 trades straight, well, it doesn't really matter. Our account won't be down more than like 2 or 3% maximum. You will never see a single day on my account being down more than 2% maximum on my worst day. Throughout the 2023 for that account, the worst day that account had was around 1.8%. That's it. No more than that. And that's what's going to make you profitable. And these setups are all probability based, but that risk management is not. If you're only focusing on this and not focusing on that, you're not going to be consistent. That's the problem. So learning this technical analysis are all great, but profitability doesn't come from these technical analysis. It doesn't come from your entry. So don't get into this bad habit of thinking you're not making money because you're getting bad entries. You're not making money. You're not keeping the money because you're not keeping the money you make, not because of your bad entry, but because you're not controlling your drawdowns. You can be very good with your entry price, but if one wrong trade is wiping out 10 different trades of profits, well, there's some work needed to be done and your focus is elsewhere and not on the thing which actually matters, which is controlling your drawdowns. So the main point of us doing with that account, we started it last November, and in 1 year it's almost up 230% and change, and on the year to date it's up around 170% and change. You can make money with any sized account by focusing on that percentage. Doesn't matter if it's a $4,000 account, doesn't matter if it's a $10,000, doesn't matter if it's an $80,000 account. Focus on the percentage, money follows automatically. And these are all just the tools to help you gauge the probabilities. But again, if you haven't downloaded the PDF for the position sizing, I'm going to share it in here with you, everyone. Just download that Excel sheet. It's going to exactly tell you how many shares you should be buying with your current stop losses for your portfolio size, so that even if you're wrong, you won't be losing more than 1% of your portfolio. So let me just download it real quick. All right. And I'm just going to share it in the chat right now. All right. So I just shared the calculator for the position sizing. Download it, play around with it, check it out. And hope this was helpful, perhaps, to add it to the watch list. And go check out that video which I shared before about the stocks chart as well. That will go over how to get these types of names, where I go to find these types of ticker symbols, which I share with you guys on a daily basis on the small accounts tab. Well, follow along. Everything else will make sense along the way. So try to avoid options into 2025. What we do works because it's boring. Simple as that. It's not filled with adrenaline. It doesn't involve any sort of stress. If you notice, if you get stopped, well, it happens. We get stopped. If we make money, well, great. We made money. Great job. We made 1% of our account when a market is trading 0. Markets are flat. Well, perfect. We outperform the markets. When we are down 0.1% or 1% of our account and the markets are down 1.5%, great. We didn't do as bad as the market did. Great job. And even if the market crashed to like 20%, our position sizing should be good enough that it shouldn't let our entire portfolio drop more than 2% overall. The worst that can happen is the overnight gap. Well, give it a 3% leeway. That's it. That's the maximum you should be losing on a daily basis. No more than that. Even 2% is a lot to lose on a daily basis, but hey, happens sometime. That's the maximum you should be losing. Learn how to lose, watch the money follow automatically. The more you trade, I'm just letting you know that if you are going to stick to it consistently for 2 years, 3 years down the line, you're going to look back and all of what I'm saying right now will make sense. Because as a beginner, I can understand that urge to make money really quick, or $100 a day, $200 a day. And isn't it funny for someone who is not even beating the S&P 500, aiming to make $100 a day on a $1,000 account, which is like 10% a day? How is it even possible? You're not even beating the performance of S&P 500 on a year-to-date basis, which is 20%. You beat it today, but you can't do it consistently. That's why people blow up their accounts. So focus on controlling your risk. Rest all will follow automatically. All these are just tools to help you gauge the probability, but your focus should be on how much you lose if you're wrong. So that being said, thank you for tuning in. Appreciate it. And what I'm gonna do is whatever I shared with you in the Zoom chat, if once I close this Zoom, you won't be able to, if you're not able to find it, you can find all of them in here. If you go to my server, and it should be under the Patreons only learning. There's the channel right here where you can see, just scroll all the way up. And if you want to find the scanner video, it's uploaded on April the 10th of 2024. You'll find the scanner video right there. And if you want that Excel sheet for position sizing, go to the beginner's guide channel, scroll all the way down, and you'll find the position sizing template and Excel sheets right there. And where is it? Where is it? Where is it? Yep, right here. It should be under spreads. All right, so check it out and download these, and step by step files all the videos explaining the basics on whatever we went through right now. All right. So thank you so much for tuning in, everyone. I'll post the recordings shortly, and hope you guys found it helpful. And follow along. I'm pretty sure you guys have a lot more questions, but following along alongside by trading with your own money is the best way to learn. And you're going to learn right now, and because your risk is no more than 0.5% on a trade. Even if you're wrong, you're not going to lose more than 0.5% of your account. If you're trading with a $2,000 account, we're talking about $10 per trade. That's all you're risking. So that is going to make you more focused on actually learning something rather than more focused on, oh, I'm sure, well, how much I'll be losing if I'm wrong. There won't be any more days. I can promise you that there won't be any more days of you losing 10%, 20% of your account on a daily basis when you're here. So that I can promise you. Beyond that, all on your hands. No more than 1% a day. And if you made 0.5% a day in profits, be proud. You did good. That doesn't matter if 0.5% is $10 or $20. You still made 0.5% of your entire account in a day. Focus on the percentage, less on dollars. Everything else will fall right in place. All right. See you guys tomorrow morning. I'll let you guys know if there's a live tomorrow. So it depends. We'll see that. We'll see if we can trade some NQ. Talk to you more.
Hey, Mario.
Hello.
Hey, this is Nicole.
What's up, Nicole? Go ahead.
Do you have are you still doing calls like every day? I don't know if I've been missing notifications or if you just don't do
Uh,
them as often.
Actually, right for the last 2 weeks, we didn't have any live streams because I'm busy planning on the wedding right now. So, I will let you know once the live stream starts. Mostly tomorrow there will be one. The next week I will be a little bit free, so we will be having a lot of live streams as per the schedule into next week. You'll see the link where you usually see in the market updates.
Okay, cool. Well, congrats. Thanks.
Yep, no problem. Bye.
Bye.
Mhm.